Hey TMFG community, Carlo here with John Iaconetti, and in today's Ask TMFG episode, John will be talking about the relationship between all of those terms you've been hearing about. Inflation, recession, layoffs, rising interest rates. So stay tuned. If you do like our content, please do subscribe to our YouTube channel, provide us with a comment or some feedback, or give us a like. In the news, we've been hearing all about inflation, rising interest rates over the past 6 months. But now we're starting to hear more and more about impending recession, and we're also hearing about companies that are laying off a lot of their employees. And there is a relationship between all of these things occurring. John will take the next few minutes to discuss what those relationships are to provide a little more clarity for all of you out there. John?
The layoffs have begun not only in Canada, but now into the US as well, as news of potential recessions could be coming our way to North America and to other major countries. Before we get into it, I'd like to give a breakdown on why layoffs, recessions, and interest rates all kind of intertwine into the market today. So, first of all, when we think of the stock market, what are we really doing? We're investing our money into companies that we believe future cash flows of those companies will be greater in the future. We expect those companies to continue to grow and provide better returns. Therefore, that is the investment that we place into them. However, stock markets begin to fall as news of interest rates increasing. And the reason why that is when we think of a company, their two biggest expenses that they have, just like you and I, debt repayments and also wages. Now, when we hit into these high interest rate periods, suddenly the future cash flows of those companies no longer look as attractive. Let's assume revenues remaining the same and their expenses now are slightly more expensive just because of those interest rate increases, higher debt payments, but also with inflation that we've been experiencing, wages have also creeped up as well. So from a company's perspective, their main focus is in order to reduce those expenses in the short term. So while there's a high interest rate period, their focus is paying down their debt as quickly as possible. When we're not in that high interest rate period, their focus is expansion. Their focus is borrowing money, creating new products, hiring new people, and so on. So this period of time is when they're focusing on their ends first. They want to be able to survive this period, so that's when they focus on paying down debt. And unfortunately, that also leads to some layoffs for some employees. Now, we've begun to see this process, like I said, in North America. Visual Capitalist has put together an excellent visual to illustrate just how those layoffs and related to the interest rates have worked. So in the chart on the screen, we've begun to realize, some of the biggest layoffs coming from Peloton and Ford, but also the more frequent news of layoffs happen as interest rates increases occur as well. So the way we see these things continue to go is, with market sentiment becoming lower and lower, less people are likely to spend just because, just like the businesses now have higher debt repayments and also higher payments in general, they're cutting back on their expenses. They're therefore spending less on these goods and services that the businesses offer, which requires them to have less employees and less staff on hand. It's all very well intertwined. The reason why this isn't or shouldn't be much of a concern for you as the investor, first of all, recessionary periods are very well a normal part of the business cycle. We are going to go through these periods in the future. Typically, they tend to happen on average of 7 to 10 years span. So these are going to continue to happen, but it's also necessary to happen for the economy. With inflation as high as it has been, if we didn't raise interest rates to combat that inflation rate will make life even more, or I guess less livable than it currently is today, right? We hear a lot of people complaining about current prices of goods and services. If interest rates don't get increased like they have been, inflation will continue at that rate and things would get out of hand fairly quickly. Second thing is, we know these periods of time don't last particularly long. And we've really looked into our history to kind of walk through that in terms of our bear markets that we have. On average, those bear markets last about 10 months in duration. And since 1926, we have gone into, I believe, 17 bear markets. So it's not a short sample size that we're dealing with here, and it's quite a big sample size leading all the way back to the Great Depression. These bear markets don't last particularly long, like I mentioned. And typically they're followed up by pretty prolonged bull market runs. And stock market, in terms of the economy, somewhat related in that sense, that these bear markets tend to happen when we do have those periods of retraction in the economy and entering into recessionary periods. So what does that mean for us as investors? What should we do going forward? Well, we don't advise in terms of timing the market, trying to get in and get out when you believe recessions will be over or when you believe the bottom will hit. First of all, incredibly difficult to make that decision because no one knows that information until after the fact. So if your expectation is to guess in terms of when we will reach the bottom and when to buy back in, and also having to guess when to sell, right? Sell at that high point. When you're having to make two of those guesses, likely not going to lead to positive returns. So what should you do then? What should you do in terms of, controlling what you can control? Most important thing is staying disciplined with your expenses, but also focusing on savings during this time. Savings is incredibly important during this time because, like we mentioned, when the markets are down, that only means there's future higher expected returns in the market going forward. Now, it's a bit of a difficult concept to grasp, but think about if the US stock market on average gets about 10% rate of return per year, and this year the US market ends up down 20% as a hypothetical number, suddenly the future expected years or future returns in future years have to be much higher than that 10% number to get them back to that weighted average. Naturally, we've seen this over time. We've seen this in our history, going back all the way back to 1926, like I mentioned, walking through how markets react after certain market downturns. The facts are there. And we've had videos on this in the past as well. Rebounds in the market in the next 1 year, 3 years, and 5 years after a 20% decline in the market. Numbers look fairly favorable to those investors. So for you today, as an action plan, if you are currently working, do have the capacity to save, now is as good a time as ever to increase those regular contributions. That's only going to mean greater returns for those contributions going forward, or even just continue your savings plans. Even if you can't increase it, don't be fearful of the market and continue to save over this period. It's only going to benefit you in the long run. If you're on the other end of the spectrum and you're currently living off your portfolio and withdrawing your funds, back to what we can control is focusing on our expenses. So actually, Yahoo Canada actually did a little bit of a survey on consumer spending within Canada, and we're already beginning to see that. Reduction in costs at the grocery stores, reduction in costs at entertainment. It's just a natural element of when prices are higher, people want to save more money, they're going to begin to cut back on those costs. So that's number one. Second part of that is controlling the amount of money that you're withdrawing from your portfolio. If you can withdraw less than you normally do on a regular basis, that's only going to mean easier recovery periods when we do get past a bear market and we're into greener pastures. So those are a couple things to take notice of. Don't be too fearful of the headlines that you're going to see in the news. You're likely going to see more information about layoffs and more doom and gloom about recessions. Know this is a regular part of the business cycle. We will get through this just like we've gotten through the many other recessions that we have faced in our history. But the important thing is to kind of flip the script, see it for what it is, and for some, could very well be an opportunity.
Thanks, John. Walking through those explanations really helps, I find, clients get through these tough times. And again, our recommendations aren't going to change much. It's all about being disciplined, looking after the things you can control, watching your spending, staying disciplined with your savings. Again, when the market does drop, all of that new savings or investments goes in at a low point and your expected rate of return is higher. So we need to maintain that those savings, keep control of expenses until the business cycle turns, which it does and has done over the last 100 years, and we'll be ready for the market to turn around. That's our episode for today. Again, if you do like our content, please do subscribe to our YouTube channel, give us a thumbs up, or provide us with some feedback or a comment. Until next time, I'm Carlo Cancino with John Iaconetti, and this has been Ask TMFG.